These are the faces of America's home insurance apocalypse. Firefighters are paying $16,000 a year to insure modest homes. Families are choosing between coverage and groceries, and entire communities have 1 in 5 homeowners gambling with financial ruin by going completely uninsured. In just 5 years, from 2018 to 2023, insurance companies canceled nearly 2 million homeowner policies across America. That is over 4 times what would normally happen in an entire year. Today, 13.4% of American homeowners, roughly 1 in 8 families, are living uninsured and without the safety net of homeowners insurance. We are not talking about a few coastal mansions in hurricane zones. We are talking about teachers in Texas, nurses in Louisiana, and mechanics in Florida, watching their financial futures evaporate as insurance companies flee entire regions. The numbers reveal systematic collapse. Florida homeowners will pay an average of $15,460 for insurance in 2025, nearly 5 times the national average. Louisiana residents shell out almost 6 times more than typical American homeowners. And in Texas, premiums jumped 55% between 2019 and 2024 alone. But here is what makes this crisis truly devastating. It is not just expensive coverage driving families to bankruptcy. It is the complete withdrawal of insurance companies from entire markets, leaving millions of Americans with nowhere to turn except understaffed state programs and the federal government's National Flood Insurance Program, which itself covers nearly 5 million properties nationwide. Welcome to America's death spiral, where climate change, corporate greed, and regulatory failure have created a perfect storm that is reshaping how and where Americans can afford to live. The roots of this crisis stretch back decades, but the acceleration has been breathtaking. Since Hurricane Andrew devastated Florida in 1992, the state's population has grown by over 50%, while climate risks have intensified dramatically. Since the 1980s, the United States averaged about 8 major weather disasters per year, causing at least $1 billion in damage. In the past 5 years, that number has skyrocketed to 18 per year. Hurricane Ian alone caused tens of billions in insured losses when it struck Florida in 2022. The Camp Fire in California generated $12.5 billion in insurance claims. Hurricane Ida devastated Louisiana so thoroughly that 12 insurance companies operating in the state became insolvent. But weather is only part of the equation. The cost of rebuilding homes after disasters has risen nearly 30% over the past 5 years due to supply chain disruptions, higher material costs, and labor shortages. When a hurricane destroys a home today, it costs dramatically more to replace than the same home would have cost just 5 years ago. Insurance companies, faced with this toxic combination of more frequent disasters and higher replacement costs, have made a calculated decision to retreat. Major reinsurance companies like Swiss Re and Munich Re have also tightened their exposure to American catastrophe risk, forcing primary insurers to bear more of the burden themselves. This is a retreat. State Farm stopped writing new homeowners policies in California in May 2023. Allstate followed suit. Farmers Insurance, AAA, Bankers Insurance, and Lexington Insurance have all reduced their exposure in Florida. Progressive, Southern Fidelity, and Universal continue operating in Florida, but have dropped tens of thousands of policies. These are not small regional insurers going under. These are household names, companies that have anchored American homeownership for generations. The human cost of this corporate exodus is staggering. Take Clewiston, Florida, a working-class town near Lake Okeechobee. One firefighter there works overtime shifts just to afford her $16,000 insurance premium. Her brother, who also lives in Clewiston, received a renewal notice for the same amount and could not pay it. He is now among the estimated 15 to 20% of Florida homeowners gambling without insurance. This isn't happening in South Beach penthouses or Malibu beach houses. Much attention has focused on expensive coastal properties, but the real epicenter of the crisis is in places like Okeechobee County, where the non-renewal rate hit 8.3% in 2023, up 4,236% since 2018. In Hendry County, the rate reached 7%, up 1,315% since 2018. These are rural inland communities where median home values are a fraction of coastal properties, but insurance companies view them as equally risky. The geographic pattern reveals American inequality at work. The hardest hit areas are not random, they are communities that were already struggling economically. Under the current system, homeowners earning under $50,000 per year are twice as likely to lack insurance compared to homeowners in general. Among lower income homeowners, 15% have no coverage entirely. The racial disparities cut even deeper. 22% of Native American homeowners, 14% of Hispanic homeowners, and 11% of black homeowners have no insurance at all. When private insurance companies abandon markets, states step in with so-called insurers of last resort. These FAIR plans were designed to be small, temporary safety nets. Instead, they have become massive programs carrying over 3 million properties nationwide, with exposure exceeding $1 trillion. Florida's Citizens Property Insurance had nearly 772,000 policies as of September 2025. California's FAIR plan covers more than 451,000 properties. Texas operates both a FAIR plan and a separate wind insurance association covering the Gulf Coast. These state programs were never built to handle this volume or risk. They lack the resources and expertise of major insurance companies, and they pass their costs directly to consumers through assessments. When California's FAIR plan faced roughly $4 billion in losses from the January 2025 Los Angeles wildfires, the state approved a $1 billion bailout, half of which will be passed on to policyholders as higher rates. The January 2025 Los Angeles fires represent a watershed moment in this crisis. The Palisades and Eaton fires destroyed more than 17,000 structures and caused an estimated $52.5 billion in economic losses. The insured losses alone, $37.5 billion, accounted for roughly 71% of global insured disaster costs for the entire first quarter of 2025. In the Pacific Palisades, where the median house is worth $3.5 million, residents had increased their FAIR plan policies by 85% in just the year before the fires struck. These disasters create ripple effects far beyond the immediate damage. Researchers at Florida State University found that a 10% increase in homeowners' insurance costs reduces housing prices by 4.6%. In California and Florida, insurance problems account for more than 20% of the nation's current home listings. Last year, 13% of California realtors reported that at least one sale fell through because buyers couldn't secure homeowners insurance, which is nearly double the rate of the previous year. Nationwide, 47% of people who bought or sold a house ran into some sort of insurance issue, and 21% had transactions collapse entirely. The psychological impact on American families runs deep. 33.7% of home searchers have completely changed where they're looking for homes due to insurance issues. People are making fundamental life decisions about where to live, whether to buy a home, and whether to start a family based on insurance availability. The American dream of homeownership is being redefined by climate risk and corporate calculations. Politicians and regulators have scrambled to respond, but their efforts reveal how complex this problem really is. Florida passed comprehensive tort reform in 2022 with Senate Bill 2A, which changed litigation rules, tightened claim deadlines, and addressed assignment of benefits abuse that had plagued the state's insurance market. The state argued that excessive lawsuits and fraudulent claims were driving insurers away. In 2024, Florida's Office of Insurance Regulation expanded who can inspect roofs for insurance purposes to include licensed roofing contractors and engineers, responding to insurer complaints about roof claims. Louisiana took a different approach, passing a $45 million incentive program in February 2023 to encourage insurers to write new policies. In 2024, the state replaced its pre-approval system with a file and use rating system, allowing insurers to implement rate increases more quickly. Most controversially, Louisiana now permits insurers to drop up to 5% of existing customers annually for any reason, effectively allowing companies to shed their riskiest properties. California has taken perhaps the most aggressive regulatory stance. Insurance Commissioner Ricardo Lara launched a sustainable insurance strategy that requires companies using state-approved wildfire models to write more policies in fire-prone areas. As Lara put it, for the first time in California history, insurance companies will be required to write more policies in wildfire-distressed areas. The state also approved State Farm's 17% emergency rate increase in June 2025, but only in exchange for the company agreeing to end new block non-renewal programs through the end of the year. Meanwhile, federal flood insurance through the National Flood Insurance Program has implemented Risk Rating 2.0, a new pricing methodology that considers individual property characteristics rather than broad flood zones. This has created additional pressure on coastal homeowners who now face higher federal flood premiums alongside skyrocketing private homeowners' insurance costs. The debate over solutions reveals fundamental disagreements about what is actually causing this crisis. Industry representatives argue that litigation and fraud are bigger problems than climate change. Robert Gordon, a senior vice president at the American Property Casualty Insurance Association, frames it in market terms. If people want to keep building more expensive homes in areas with high climate risk, the cost to insure those are going to increase. Consumer advocates see it differently. They point to studies showing that factors like credit scores can matter more for insurance rates than actual disaster risk. Unlike California, which prohibits using credit scores to set home insurance rates, Florida allows it. The Consumer Federation of America found that a homeowner with a low credit score pays nearly $2,000 more per year for insurance than an identical neighbor with a high credit score. This means the insurance crisis compounds America's broader inequalities. The scope of what Americans face when they lose insurance coverage is still poorly understood. Mark Friedlander of the Insurance Information Institute explains the reality. A lot of people think, I'll just rebuild with FEMA help if something happens. But FEMA doesn't replace your house. They offer temporary shelter and basic support. If you don't have insurance, you're starting over with nothing. Consider what starting over with nothing means for a typical American family. The median American household has a net worth of about $121,000, with most of that value tied up in home equity. A total loss without insurance does not just mean finding new housing. It means losing a lifetime of savings, destroying children's college funds, and potentially facing bankruptcy in your 60s or 70s when recovery is nearly impossible. The psychological toll extends beyond individual families to entire communities. In Texas, approximately 47% of homeowners' insurance claims filed in 2024 were closed without payment, meaning nearly half of people who thought they had coverage discovered they were essentially uninsured when disaster struck. This creates a culture of distrust and anxiety that pervades daily life in high-risk areas. Some signs suggest the market may be stabilizing, though at a much higher price point. The homeowners insurance market is projected to post double-digit premium growth in 2025, with a return to overall profitability expected in 2026. Carriers are easing some of the strict underwriting restrictions introduced in recent years, with data showing a 69% increase in available quotes per person from March 2024 to July 2025. Louisiana has seen some success from its reform efforts, with 10 new insurers beginning to offer products in the state since 2024. Stabilization, at current price levels, however, has serious consequences. When stabilization means $15,000 premiums in Florida and $14,000 premiums in Louisiana, entire demographic groups get priced out of the housing market. The crisis is effectively creating a new form of economic segregation, where only the wealthy can afford to live in large swaths of America. The long-term implications extend far beyond individual homeowners. Municipalities that cannot attract residents because of insurance costs face declining tax bases and reduced public services. Schools in high-risk areas struggle as families move away. Local businesses lose customers and workers. The economic vitality of entire regions is being undermined by insurance market dynamics. Climate scientists warn that the weather patterns driving this crisis will only intensify. The specific sequence of events that created the devastating 2025 Los Angeles fires Heavy rainfall in February 2024 that spurred vegetation growth, followed by the second driest season since 1877 that turned that vegetation into tinder, represents the kind of extreme weather swings that climate change is making more frequent and severe. Martin Weiss, founder of Weiss Ratings, believes the situation requires fundamental restructuring. He says that what we need is a complete revamping of the structure of the insurance industry in Florida, and that we effectively have to build the market from scratch. Other experts describe it in even starker terms. A former California official put it bluntly: the insurance crisis in the U.S. is the canary in the coal mine, and the canary is dead. The crisis is exposing uncomfortable truths about American housing policy and climate adaptation. For decades, federal flood insurance, disaster relief, and tax policies have subsidized development in high-risk areas. Now the private market is essentially saying those subsidies were economically unsustainable. The collision between market forces and political expectations is creating a policy crisis that goes far beyond insurance regulation. As we look toward the future, the fundamental question is not whether this crisis will be resolved, it is how American society will adapt to a world where large areas of the country are essentially uninsurable by private markets. Will we see mass migration away from high-risk areas? Will the federal government step in with a national insurance program? Will we develop new models of community-based risk sharing? Will technological solutions like better building materials and early warning systems make dangerous areas manageable again? What's certain is that the old model, where Americans could buy a home anywhere in the country and expect reasonably priced insurance to be available, is over. The new reality requires difficult choices about where we live, how we build, and what level of risk we are willing to accept. For millions of American families, those choices are being made not by preference or lifestyle, but by the cold calculations of insurance company actuaries and the relentless mathematics of climate change. The home insurance crisis in America is not just about insurance. It is about the future of American communities, the accessibility of the American dream, and our collective ability to adapt to a changing climate. In Clewiston, Florida, in the fire-scarred hills of Los Angeles, and in flood-prone parishes across Louisiana, families are already living in that future. The question is whether the rest of America is prepared to join them.